Hey, it's time for another video here at Mortgage Clarity. I'm Joshua Kittle here. And in this video, I want to talk about a bank statement program as a way to generate the income to qualify for your mortgage. Now, this would fall into the non-QM or non-qualified mortgage program. To know more about what a non-QM loan is compared to a QM loan, check out my video where we go into detail about kind of what the differences of those are and whether or not it's good or it's bad. So let's just jump into this one here, bank statement program. So what this is for self-employed borrowers, and it's a way for a self-employed borrower to document their income other than the traditional source of using tax returns to do so. Self-employed borrowers, sometimes the way they do their taxes, they write off a lot of expenses and stuff. And when we look at tax returns, the way we have to treat them, we may not be able to use as much income as maybe they're really showing through bank statements. So the way this program works is, and this will vary from investor to investor, so definitely this is just a general overview, but the program will be either like a 12-month, 18-month, or 24-month bank statement program. That's how many months of bank statements you need to provide. Well, let's just take a look at a 1 year. So what we would do is we would actually have the borrower provide the most recent 12 months completed bank statements for their business or personal account. They would choose which way they would want to go. Then we would review those bank statements and we would add up all the deposits that from the business that we see coming into those accounts. And then we would subtract out of those deposits any deposits that don't seem to be business related, like maybe a refund or something like that kind of came in, or a one-time non-recurring non-business type deposit. So we back that out and we get to our gross or our net deposits as a number. Then, based on the type of business and the size of employment, we're going to add some type of expense ratio to that, because obviously you run a business, you're going to have expenses, so that's going to be accounted for. So let's just say then you're a self-employed borrower, you own a window washing company, and it's just you. Given it's a low dollar item, it's not like you're selling houses which have large deposits. And I'll talk about that one here in just a moment. You're probably going to look at just using 15% of your gross deposit as expenses. And then from there at point, we're going to divide what's left over, and there's your income. And then at that point, we go forward with looking at your debt to income ratios. But now let's just say you're a self-employed window washer, but now you employ 1 to 3 people with your business. At that point, we're now going to use 40% expense ratio, because if you've got employees, you have additional expenses, particularly if they're full-time employees, of course. And so that gets factored in. But let's just say you're not let's just say you're a self-employed person, 1 or 2 people, but you own a restaurant. When you have high expense type businesses like that, or high net worth, so like say restaurant owners, a lot of expense in food, employment, and very low margins. Or maybe you're a property flipper where every year you buy investment properties, fix them up, and sell. These types of things have very high expense to earnings ratios. And so in that case, you might be looking at using 80% of the gross deposit as your expenses. And then you have the leftover 20% to qualify. So there's a few different categories here, but that's basically what's going to happen is the lender is going to look at the sum deposits of either the personal or the business statement, account for some type of expense ratio. And if your expense ratio is kind of out of line, the lender wants to say hit you for 80%, but hey, it's way lower than that. If you have a CPA that's able to write your letter and confirm that in your past fines, your expenses are lower than that, you might be able to get by with that. But regardless, you're going to do that, account for it, come to a net income, divide by 12, use that to calculate your debt to income ratio. And if you qualify, you can use a bank statement program to get yourself your home. So if you have any questions, please let me know. I hope you found this video helpful. Down below, comments, definitely type those in there. If you want to have specific questions for yourself, reach out to me directly through an email. And if you haven't already, hit subscribe. That way, as other new content comes online, you'll be alerted to that as well. All right, thank you so much and have an excellent day. Bye for now.